Well, ladies and gentlemen, welcome to Grant's Radio. We are podcasting, Evan Lorenz and I'm Jim Grant. We are podcasting on the topic of the current issue of Grants. And Evan, if I do say so, and I do say so, it is merely fabulous. You agree, Evan?
Oh, wholeheartedly.
Let's begin by talking about what's in it. I want to begin by the cartoon, which is not the least important part of what we do. And here's the cartoon. Okay, so the scene is a dining room table, a husband and a wife. He has a mouthful of her cooking, and he is looking at her with a certain amount of amazement and husbandly guilt. And what she is saying to him is, quote, "How can you eat knowing that that man is president?" So that is the cartoon. And because we're not going to talk about religion, having discussed politics, we're going to dive right into the financial content of the current issue of Grant's Interest Rate Observer. And with me is the deputy editor of Grant's, the inimitable analyst, Evan Lorenz. So Evan, here's what I propose that we talk about. We're going to talk about Detroit and its woes, or most of these woes are to come. We're going to talk about margin of safety, this central doctrine in investing, especially value investing. We're going to talk about bank credit, and we're going to talk about the future. The future is a very big topic, Evan, but I think we can handle that in the next 18 minutes. So let us begin with one of your major contributions to this issue, which is a piece we have headlined "Disabled Vehicles." And this concerns cars, trucks, credit, and trouble. So would you give us a quick overview on how you conceive this story and how we are presenting it?
So the curious thing when you look at the auto lending world today is delinquencies and defaults are spiking at a time when the economy looks to be doing pretty good and employment is improving every single month. It seems like the explanation for this is not that the consumer is doing badly, but that lenders had lent too well and perhaps not wisely enough. Consumer credit had improved, post-crisis as consumers worked their ways out of the defaults on mortgages. They moved from subprime perhaps to prime, and lenders were doing perhaps better than they had expected on vintages through 2015. However, in 2016, lenders appeared to have gotten a little bit too aggressive, and delinquencies actually were spiking above what they expected. At the same time, because auto sales had fallen so hard during the crisis, there were a few late vintage used cars coming onto the market, which had a salutary effect towards used car prices. Now, used car prices seem kind of like an ancillary thing or something that's not very important. But in fact, used car prices are kind of core to a lot of parts of the auto.
Nobody talks about that used car smell, right?
No, everyone would prefer a new car,
Yeah,
all
right.
things being equal. However, used cars kind of grease the entire car market. 9 out of 10 car sales involve a trade-in, so if used prices are low, consumers can less afford a new car. Lenders lend in part based off of their expectations for recoveries if loans go bad. So if used prices are lower, that actually means lenders will restrict terms. But high used prices also mean that lenders are more willing to extend leases to consumers because they're better able to predict the residual value.
So our story describes the kind of the arc of the credit cycle in cars and trucks, and we describe how on very easy lending gave rise and helped to give rise to the crisis that ended in 2008 and 9, and how sackcloth and ashes came over the lending community, and at length how these lenders perked up and began doing all over again what they had done in 2006, right? Which is the eternal cycle. And it's playing out how? How might our readers expect to see the world in a couple of years based upon what has happened, Evan?
Well, the things to expect are even lower used car prices, which are going to actually force the OEMs, the GM, Ford, Chrysler, to offer higher incentives to move new cars. It'll see larger losses for the lenders that had offered leases, lower recovery values when loans do default, and it may actually slow down the whole, sales cycle, because if consumers are less able to afford a car because used prices are down, the SAR might actually fall a little bit.
Well, the thing about easy credit is that, of course, it pulls consumption forward and it pushes failure or the recognition of failure out into the future. And we've seen this in many different departments of American finance, and now we're seeing it in a very, very big department indeed, namely the automotive one. So that's so much for four wheels. Evan, let's talk about the margin of safety. This central concept to a value investing, and one associates the margin of safety with, of all people, with Warren Buffett.
Indeed, Warren Buffett and his partners 3G Capital, which are the brilliant Brazilian investors who've run Kraft Heinz and Restaurant Brands International, amongst other companies. Restaurant Brands just paid the most expensive multiple ever for a North American restaurant, Popeyes, 21 times EBITDA. At that multiple, there is a glancingly small margin of safety. If anything goes wrong, this deal could actually end up losing that company money.
Yeah, I invite the readers of Grants to go back in our archives, our not so dusty archives are quite accessible, and look up a story headed "More Junk Food." The date is October 27th, 1989, and in that story you will see the seeds planted of today's leveraged transactions in restaurant stocks. So nothing exactly is new under the sun. This margin of safety business it seems to me, it is the central concept for finance today. We see it, for example, in the European debt markets. Now, there's a great political drama building in France. Marine Le Pen either will or will not prevail, and if she does, shockingly, well, not shockingly, because we know that she says that she will do something, and what she says is that she will take France out of the Eurozone, out of the euro, and reinstitute the franc and redenominate most of French sovereign debt in the not now existing franc. Shocking, right? So how is the market responding to this? Well, it is demanding a skyscraping yield of 1% on euro-denominated French sovereign debt. Is that sufficient for you? Speaking as an individual, I'm not holding.
Not for me.
Okay. And how is this playing out in other European debt quotations? So what's happening in Germany, for example?
The 2-year Bund actually reached an all-time low yield today, or an all-time high price. I believe it's almost negative 1% if I were to check my Bloomberg today. So as investors are fleeing the 1% yield on the 10-year French sovereign government bond, they're fleeing to a negative 1% or near negative 1% for the 2-year German Bund.
Yeah, allow me to put in a plug for my old friend Gold Bullion, which kind of needs a pat in the back, or indeed a hug from time to time, and why people choose to flee into the promises of a sovereign government paying a currency that's been in existence for less than 20 years, when they can buy at a not so extravagant price the ancient monetary medium that costs something to produce, that looks good, and that glints when left in the sunshine. Why they choose the bond is beyond me. However, this will end the lamentation that I disguised as an investment idea. So, Evan, let us talk also about this thing called long-term investing. Whatever happened to it? And I ask this question rhetorically because Bank of America Merrill Lynch recently polled 200 or so institutional money managers, and they asked them, among other things, how many of you believe in the idea of secular stagnation? Very fancy phrase, secular stagnation, which means, to use a technical term, meh. It means persistently low growth and chronically droopy prices, not over a year or two or three, but over, say, a generation. This was a term, secular stagnation, that came into the language in the late 30s. One of Keynes's disciples, Alvin Hansen, coined it, and Larry Summers recently picked it up and has popularized it. So a year ago, more than 80% of respondents to the Merrill Lynch poll said, yes, they credit the idea of secular stagnation. Shocking, right? This is America.
Yeah.
Of course, a year ago, the stock market was going down. This year, Evan, if you haven't noticed, the stock market is zipping higher. And what percentage of the respondents would you guess say they now credit the doctrine of secular stagnation? Well, I'll tell you, don't guess. 43%, about half of the respondents who last year said they believed it. So what's the half-life of a long-term conviction, Evan? About 6 days, 6 weeks?
I think the problem is the definition. I think long-term now means more than 2 quarters.
Maybe it's not so much a question of time as of market action. This reminds me of a story that Leon Levy told about himself in the Metropolitan Museum of Art. Leon and his wife, Shelby White, were prepared to settle on the Met, a very, very big gift, and they were to receive in return the Leon Levy and Shelby White wing. And the head of the museum, Philippe Montebello, promised them, the two of them sitting there, they promised them that their names would be on this in perpetuity. And Leon asked, how long is perpetuity? And Montebello said, for you, 40 years. Yeah, so plus ça change, Evan. Now, finally, let us turn to the state of bank credit. And this was another Evan Loren's contribution to this issue of grants. Tell us about the curious flattening of the growth rates in bank credit over the past 3 months.
If you look at either consumer and industrial loans, which are loans that banks extend to businesses, or just bank credit in general, it's come to a standstill in the last 3 months. Businesses are not borrowing. The demand does not seem to be there anymore. It's crashed.
Well, has this been corroborated, this evident trend in deceleration? Is this corroborated by sightings in the more everyday business world outside of finance?
In fact, there was one earlier this week. IHS Markit, which is a market research and analyst firm based in London, has a flash PMI. According to their composite PMI for the U.S., which includes both the services part of the economy and the manufacturing part of the economy, business expectations are now the lowest that they've been since September 2016, which means that we've retraced the entire Trump bump.
Well, I think this is about all we ought to tell the readers of grants, because they ought to read this this delicious prose for themselves. I think this is just about enough radio for the day. But I want to thank you, Evan. I want to thank our technical staff, and I want to thank especially the readers of grants, the noble readers of grants, for reading and listening. And thank you until next time.